For certain tax rules, the IRS treats related corporations like they're one big company. That's a controlled group. On the EA exam, this shows up because controlled group status changes what the group can claim, and it triggers related party rules. Your first job is classification. Are we looking at a parent owning corporations or individuals owning multiple corporations? Why do you care? Because controlled groups share limits and get grouped together for several tax purposes. They may be eligible to elect a consolidated return, and they can't play games with losses on related party transactions. Also, some benefits are one per group, like the accumulated earnings tax credit. And for certain retirement plan rules, employees can be treated as one pool. Parent-subsidiary is the clean one. If a parent corporation owns at least 80% of the voting power of another corporation, you have the start of a parent-subsidiary controlled group. Then you can chain it. Corporations that are 80% owned by the parent or by a subsidiary can be pulled in. Exam tip: foreign corporations aren't treated as members for this controlled group determination. Apply the 80% test like a bouncer at the door. Express Corporation owns 80% of A and B and 90% of C and D. Both meet the 80% threshold, so all three are in the controlled group, with Express as the parent. That's the classic fact pattern where the group may elect to file one consolidated Form 1120 instead of separate returns. Now the Sunshade example shows the cutoff. Sunshade owns 90% of Arch and 80% of Barstow, so those two are in. But Sunshade owns only 65% of Crane, so Crane stays out. On the EA exam, they love mixing in one corporation, just under 80%, to see if you accidentally include it. Brother-sister is trickier because the owners are people, estates, or trusts, not a corporate parent. Two tests apply. First, the same 5 or fewer owners must collectively own at least 80% of each corporation. Second, those same owners must have at least 50% identical ownership across the corporations. Identical means take each owner's smaller percentage in each company, then add them up. Use the innovation and keystone table to practice the identical ownership idea. Add the common pieces. Elvin's identical part is the smaller of 70% and 30%, so 30. Geary's is the smaller of 10 and 50, so 10. Wayne's is the smaller of 20 and 20, so 20. Total identical ownership is 60%, which clears the 50% test. And the same three owners own 100% of each, so the 80% test is also met. Which of the following is not considered a related party to a corporation, and therefore not subject to the restrictions on related party transactions? Choices include a corporation in the same controlled group, an employee shareholder of a personal service corporation regardless of ownership, an individual who indirectly owns at least 25% of the corporation, and a trust fiduciary when the trust or grantor owns more than 50%. Think about it. The correct answer is the individual who indirectly owns at least 25%. That sounds like it should be related, which is why it's tempting. But for these related party ownership rules, the key threshold is generally more than 50% direct or indirect ownership, not 25%. The controlled group member and the more than 50% trust situation are classic related parties. Summit Robotics is a C corporation that owns 15% of Cedar Ridge Timber. Summit has taxable income of $135,000 before dividends. This year, it received $60,000 of dividends from Cedar Ridge. What is Summit's taxable net income? The options include $105,000, $195,000, $165,000, and $135,000. Think about it. The answer is $165,000. Because Summit owns less than 20%, it gets a 50% dividends received deduction, so the DRD is $30,000, leaving $30,000 of taxable dividends. Add that to the $135,000 pre-dividend taxable income, and you get $165,000. The tempting wrong choice is $195,000, which ignores the DRD.